Hi, everyone. Just before we get going, I want to remind you that everything we talk about and discuss should not be considered as investment advice. The purpose of what we talk about on Catherine Murray Media and Markets on YouTube, as well as Catherine Murray in Conversation With on my podcast, should be viewed as informational and entertainment purposes only. Please definitely do your own research, your own homework, and definitely consult an investment professional before making any investment decisions. And also to note, some of us might hold positions in some of the stocks that we discuss.
Hi, everyone, and welcome once again to our Top 5 at 5, where we get some of the best minds for you on the investment front to kind of give you their big picture, but importantly as well, really to get their top stock ideas. And what I love about this as well is that we do it in 20 minutes. So it's very and today we have Christine Poole, who's a veteran in the equity markets. And Christine, I don't know, fixed income as well, or is it always been really equity focused for you?
I mean, my focus is equities, but we do have a balanced asset mix strategy that we offer our clients, which includes fixed income as well.
Okay, great. Let's get started here in terms of your big picture macro views. In the notes that you sent over, I thought it was really interesting to talk and to really focus in on what's happening. We don't talk a lot about it, but deglobalization, and we don't talk about it because it's been, decades of globalization.
That's right.
But there is the possibility that we really are in a new era of deglobalization. What does that mean to you? What does it look like?
Well, you're right, Catherine, and we've seen more and more commentaries about people writing about it, like Larry Fink last week and Howard Marks in his most recent note. And I think you're right. Like the last 30, 40 years, it was all about globalization, moving your cost of manufacturing to the lowest cost in the world, which was beneficial for developed worlds because we got lower price goods and it was deflationary, and it was good for the countries that were getting the manufacturing activity because it was helping their economy to grow. And I think given what's happened the last few years, and it's not just the Ukraine-Russia war, but even with the health crisis, companies woke up that, wow, have your factories overseas somewhere where, that's impacting those economies much more differently than over here to try and move the goods over. That created a lot of difficulty. And so we first start, I think, seeing some of that move about not even maybe deglobalization, but more local sourcing or onshoring that, you saw the semiconductor industry. We know there's a huge shortage. They started to make moves to have more foundries built in the United States. Intel's doing that. We've seen announcements by Taiwan Semi and even Samsung to start building facilities in the US so that it's closer to the end market. So that was kind of a shift. And then now with the Ukraine-Russian war, realizing that you don't want to be dependent on a politically different ideological countries on key materials and goods. And so you've got the EU moving to decrease the reliance on Russian, energy products. So what does that mean? More imports from politically or more democratic friendly countries like the United States, potentially Canada, more LNG facilities, and as well, maybe accelerated growth to renewables. I mean, that's been an ongoing trend. And maybe there's a renewed focus. You're seeing that in Europe that, maybe we have to focus more on getting more green energy to displace the Russian energy.
Mm-hmm. Just to pick up on the point about Europe receiving LNG from the United States, can we just talk a little bit about that? Your sense in terms of how quickly that can actually happen and to what degree and from a capacity perspective?
Well, I think the United States already announced that they're going to start exporting a certain amount, but it's definitely not going to displace what Russia has been exporting to the EU. So that will take some time. And we know LNG facilities typically take years to construct. I read something this morning about a small, I think, private firm that's proposing to get something up and running smaller within the year. We'll see if that happens. But I think Europe is also trying to source some other countries that's over there that, they can, that's not Russia, but it will take time. I mean, definitely. And you saw the announcement with this morning, Biden supposedly is going to release of strategic reserves, which to help kind of alleviate the short-term supply crunch. But it's not going to be a fast solution, definitely, Catherine, which is why I think, it's going to require money, funds, and if governments decide that, okay, let's focus on renewables, that's a matter of just providing funding and accelerating that construction process. But it is going to take a while, and OPEC seems to be quite content right now to stay the course and not increase production too quickly.
And so am I hearing from you then that, and we're going to get to your topics in a second, but it sounds like as though you're definitely setting up to invest in some renewables and infrastructure on that front. But it also sounds as though you're planning for higher inflation for longer, because, this will be the reverse of globalization, which decreased the cost for all of us across the board. I mean, remember years ago when we all wanted a big TV and it was just so expensive. I mean, I'm going back 20, 25 years ago. It was such a luxury item, and then it became so commonplace. There might be reversals of maybe not TVs, but other aspects or new products that we haven't even thought about yet.
Yeah, I think you're right that I do think inflation will stay higher for longer. I mean, my perspective pre the war was that things would start to improve in the back half as the supply chain issues resolved, as the health crisis started to pass. And now you've got food and energy, spiking up. And while we know the central banks tend to exclude that component when they measure inflation, it's going to definitely hamper households because you're paying more. And that may mean that they're going to have to spend less in other areas of the economy. So for myself, corporate profits is really the key driver for equity markets. And I think we're just starting to see maybe some earnings revisions downwards, because many companies, when they reported their fourth quarter, they were alluding that, yes, things were getting a bit better, but perhaps towards the latter half of this year, they would see much more easier access to various supplies. And that may not happen as quickly. So right now, consensus is still for, let's say, the S&P 500 and the TSX to grow earnings in that mid-single digit range. Now, perhaps energy will displace some of the low earnings from other industries, but that's something to watch for, because that would be a negative for stock markets, I think.
Yeah, absolutely. I think that this current quarterly reporting season, which is going to begin in the next week, is going to be really key and critical in terms of the guidance and what that might mean for stocks. And I think if anything now, well, at least for the past year, 2 years, it's been critical to be a stock picker in the stock market. So actually on that note, let's take a look at your first pick, which is Google. This is a name that you'd buy today, you own, and you'd feel comfortable continuing to own in and amongst all of this uncertainty.
Yeah, because, I think there's we classify stocks into general categories, Catherine, income and growth stocks. And definitely, I think Alphabet fits into that category of growth. They are in a secular growth industry, which is important when you have an environment where the economy is probably stalling. We're seeing revisions downwards for economic growth. So obviously, online advertising is going to probably outgrow the normal economic cycle, and Alphabet's very well positioned. They've done very well the last few years, and kind of you can see really outperforming Meta, which is Facebook, their primary competitor for online advertising. And I think also in a rising interest rate environment, you want companies that have very strong balance sheets. Google has a net cash balance on its balance sheet. That's about $200, almost $200 per share in cash. And so it's trading at about 24 times forward earnings. So not inexpensive when you look at even the market multiple has come down. But I think for a company that's going to grow, let's say their top line around 15%, very high margins, and they have other areas like the cloud business, which is not turning a profit, but as it gets larger, I expect it will. And that's another high growth area, cloud infrastructure. All companies are looking there to increase productivity. So I think that's a good name to own in that large cap tech space.
Christine, it's interesting because when I think about large cap tech today versus the early 2000s, when the tech bubble burst, those large cap companies, tech companies that had a higher multiple, much higher than what we're talking about today, took 10 years to kind of recoup those stock losses. When I think about today and the innovation that's taking place within tech, taking us to another world like the metaverse, there's part of me that feels comfortable owning a Google, even if the market goes down, because of all the innovation and growth that they're doing versus the big tech companies, from 20 years ago that were really just product based and solely siloed focused.
Yeah, no, I think you're right. I mean, they've got, artificial intelligence. That's one of their key tools to help their customers advertise more effectively. And they have, like, I talked about, they have the other little, what they call other bets, whether it's Waymo, with this driverless car industry, which could be very disruptive potentially down the road. It's still evolving. And they make a lot of money, unlike some of the tech stocks that you talked about during the tech wreck. They were kind of concept stocks. They weren't, these companies are very profitable when you think about even Alphabet or Microsoft. Their margins are very high, they're growing. And as I said before, they have very strong balance sheets to tap into the reserves to invest for the future. And they're doing that.
Okay. Let's take a look at the next top pick, Brookfield Asset Management. And I feel like this is one of those names that, you can buy it, you own it, you almost don't have to look at it, which you should never not do. So I don't know. How do you look at this company and continue to have confidence constantly?
Well, they are a diversified company that, also alternative asset management, I think, is a growth industry. So once again, that secular growth theme, it is growing. Yes, interest rates are going up, but I think not to the extent that, many of their, pension funds and sovereign wealth funds, they want to invest in hard assets. And this is what Brookfield does if you look at all their different silos. So I think it's good for a retail investor in particular to own Brookfield, because you get exposure to real estate, to infrastructure, renewables, private equity, credit. They did a great, they bought a 60% interest, I think, in Oaktree a few years ago, which is very established in credit. So that was a brand new platform for Brookfield. They decided to buy versus grow it internally. And so that automatically doubled their client base. And they're doing a lot of cross-selling, and they've been very successful, as you know, Catherine, at raising money. Mark Carney's the vice chair for their Global Transition Fund. So they're all in the right areas of the market. And definitely this company's been around for a long time. Management is very capable and has a solid track record. So, you can buy some of those independent verticals that I mentioned that trade, or you can buy Brookfield, which is kind of a culmination of all of them. And I think they will benefit in this environment because they're very, they actually like disruption or dislocation, because it gives them an opportunity to buy assets at a lower price. I think I was reading his fourth quarter shareholders note when everyone hated real estate during the midst of COVID and thought, no one's ever going to a mall again, or et cetera. They were picking up, inexpensive assets. And now they're actually selling some of them and making a nice return even after just a year. So they like to go into areas that are distressed and buying low and selling high, which is what one should do, right?
Yeah, absolutely. So just to kind of recap here, it's a way for the retail investor to own alternative assets, an alternative asset manager, which would include, the real estate, as you mentioned, infrastructure, but private equity as well, which, most people can't get access to unless they're an accredited investor. And then you've got on top of that, some of the best, smartest minds in the world managing that company, Brookfield Asset Management.
That's right. Yeah, exactly.
Okay. And there's a dividend. It's not, I forget what it is. It's not huge.
It's about a 1%.
It could be bigger.
I think it's not huge, but it's like dividend. I think they're more interested in growing their cash flow and reinvesting versus paying out cash.
Yes. Yes, it's always a decision. Let's take a look at the next one. Fortis trades on the TSX, and the ticker there is FTS.
Yeah, so this is your boring utility company. We've owned it. It's a core income stock for us. The yield is about 3.5%. So not the highest yield, but I think it's a reasonable yield in this environment. And more importantly, this company, their cash flows are very defensive, visible because of their regulated operations. The bulk of their assets is generation, distribution. They do have distribution and just not generation is actually a very small component, but they are transitioning one of their generating assets is coal to renewables. So that's an area of growth. And as many for Fortis, they have a big presence in the United States. And so as we get more renewable sources put in place, you're going to need transmission lines built in to get that generation to the end consumer. And as well, in this rising rate interest environment, I think it's very important when you're looking at income stocks to look for companies that will increase their dividend annually, because that will act to be a buffer to rising interest rates. And Fortis has indicated, given their backlog of capital projects, that they can increase their dividend 6% annually through 2025. And they have 48 years record of increasing their dividends every year. So that's what you want to look for, that track record and the visibility in their cash flow to increase their dividends.
What's the risk with buying it now?
Well, the risk, I guess, is if we actually get the war ends tomorrow, and all of a sudden growth becomes the new, everything shifts back to growth. So then these more defensive areas like utilities will likely lag in stock performance. But I think that's fine because you're still going to get that yield, and they're probably still going to be able to grow their share price a little bit. It'll lag in a market like that. Or if maybe rates really spike up very sharply in the near term, then of course, as you know, Catherine, other income producing areas like utilities, they tend to maybe, you have a competing, bond rates really spike up. So once bonds are, let's say, get to 5 or 6%, then maybe the 3.5% dividend you're getting from utility is not quite as attractive. But the flip side is that if we're in this period of uncertainty, growth is slowing, perhaps a recession may happen in the next 12 to 24 months. We're not sure the timing. Then these are names that will do well, I think. So you want to have a defensive component in your portfolio as well.
I just interviewed on Tuesday Joe Rabel, who's one of my favorite technical analysts on Wall Street. I used to work with him.
Okay.
And he was really highlighting the utilities as showing up very strong on a technical perspective. We didn't look at the Canadian ones, but on the US front, absolutely. Yeah. Pretty interesting. Let's take a look at the next one. Linde, Linde.
Yeah, Linde PLC. It's an industrial gas company. It's a kind of an oligopoly. Their competitors are Air Liquide and Air Products. So Linde merged with Praxair, which was a US-based company a few years ago. And the reason why we like Linde, earlier I spoke about the semiconductor industry and how they're building facilities closer to the United States, et cetera. Foundries, semiconductor manufacturing requires a lot of specialty gases in their process. So electronics is one of their end verticals, and it's showing very good growth. And so they're benefiting from these new foundry builds because they will supply directly to the foundry these specialty gases. And Linde also, it tends to be relatively defensive. It is an industrial, but even in 2020, in our last recession, their revenues, they still managed to grow it kind of low single digit and grow their earnings actually double digits. So they're very productive in terms of adjusting their operating costs when things slow. And the company even said for this year, even if they anticipate no economic growth, they feel they can still grow their earnings double digit. But they are seeing decent growth in all their vertical markets. And once again, we talked about LNG or chemical plants, they all require gases, like that's what they do. And Linde also participates in kind of in the future, the clean energy path, because they will provide hydrogen, green hydrogen, all different colors of hydrogen. And they're helping actually to build out a hydrogen infrastructure in South Korea. So there are a lot of interesting end markets that I think will have nice growth rates in the future.
Do these companies though, when I remember, covering or spending time on Air Products and Praxair, they do move in conjunction with the economic projections and economic outlook.
Yes, there is obviously because as the economy improves, there's more manufacturing or whatever activity. So there is that extent, but some of Linde says that about 40% of their vertical markets, that's healthcare, electronics, clean energy, those are more defensive and not as cyclical. If you think about healthcare, they supply oxygen, various glasses for MRIs and X-rays, and those things don't really follow the economy. And obviously they did benefit during COVID because there was more oxygen required at hospitals. But on the flip side, as things are opening up, you have a surge, all the elective surgeries coming back. So there is some markets that are not as cyclical, which I think will benefit them.
Okay. Let's take a look at your next top pick, WSP Global, WSP on the TSX. Tell us a little bit about the company fundamentals.
Sure. So it's a global engineering design and services firm based out of Montreal. Even though it is Canadian based and listed in the TSX, very global. About 17% of the revenues are in Canada and the rest is around the world. And, they are great. Why we like this space, first of all, one, just generally speaking, they did a great acquisition about a year and a half ago, Golder, which was a leading player in the earth and environmental side of engineering, which is a growing area. Everyone's becoming much more aware of, the environmental impacts of any facility they're bringing in, or even mining and oil and gas. And so they will grow organically. I kind of in that they're guiding to about 5% organic growth, but they also will grow through acquisition, because it is a very lots of different small companies out there like to grow by acquisitions. You're buying people, and they have very good relationships, and they've been very successful in doing that. That's how they have been able to expand globally, as well as through different verticals. And I think they continue to do that. Balance sheet, once again, very strong balance sheet to do that, to take advantage of opportunities. And they have two core shareholders, like the case and CPP own about 15% of the company each. So I think, that's kind of nice too, because when they come across, when they want to buy, they typically will participate and provide funding as well. So, and then we talked about onshoring or whatever. I think if we see more construction activity, obviously the design companies will get involved. And, I'm sure WC will be in there. They don't do construction. And that was one of the reasons why we like this company versus some of the other companies. Construction, tends to be the area where these E&C companies get into trouble, because they get into cost overruns, and it can have a lagging impact on, as on financials for a very long time.
Right. So this company sticks right with the design and the engineering capability, not taking on the construction costs and construction risks, which means you have to price things right, etc. So,
and we know we've got a few companies in Canada run into difficulties, right? And it takes a long time to roll off sometimes. So so they've say they will stick purely with services and design advisory services.
Okay, Christine, that was great. And just for everybody who's listening to know, Christine is the CEO and Managing Director of Global Invest Capital Management. So people can reach out to your company. What do you provide in terms of, is it segregated accounts? Is it pooled accounts? What is it?
Yeah, it's all segregated portfolios, meaning that our clients all own the underlying stocks or bonds. We do not tend to buy mutual funds or ETFs. So it is purely individual securities that they own in their portfolios. Nice. And is there a minimum? Minimum is about it's typically 500,000. Okay. And so, but we're spread across Canada, and so if anybody has any questions further, feel free to follow up with me. Excellent. Okay, Christine, thanks so much for today. Top 5 at 5. Thank you. We'll see you soon.